Morning, everybody. This is our disclaimer slide. Obligatory. I think, Jeff, you can pull those down now. Those are down. I'm Michael Episcope, co-CEO of Origin Investments, and you are here today to see the IncomePlus Fund webinar. And joining me today is Marc Turner, Managing Director of Investments. And many of you know Marc as he is a regular on these webinars. Welcome, Marc.
Yeah. Good morning, Michael. I'm looking forward to our conversation.
Always great to have you. Marc's team is responsible for executing the business plan on every single deal, asset valuation. He's really involved in every single asset in this firm, and he's one of 5 credit committee members as well. It's great to have you here, as always, Marc, and I'm sure there's going to be a lot of questions for you near the end as well. The webinar today, it's going to be about 35 to 40 minutes in length. And the last 20 minutes, we always leave for Q&A. And if you have questions, please enter those into the Q&A, not the chat box. We do try to anticipate your questions and get to those throughout the presentation. And for those of you who provide us with feedback on these webinars, we appreciate that as well. So we always try to make these better each and every time. We're here for you. I'm going to cover the macro environment, fund overview, and then dive into the portfolio valuation. And then Marc is going to go into more depth into our individual deals. And after that, we'll open it up for the Q&A. And I was looking at my notes. The last time I hosted this webinar was back in April of this year. We did have a subsequent one between that, but that was the last one I did. And when I was looking back, I saw that we were in the middle of the banking crisis. It was kind of unfolding at that time. The 10-year was around 3.4%. Borrowing costs in multifamily were approaching 5%. And cap rates were kind of jumping to around 4.5%. At least that's what we were anticipating. They were probably 4.25% at that time. So a lot has changed in the last kind of 6 months, but a lot has not. It's just a lot more of the same, if you will. And we also opined at that time that 2023 was going to be a tough year for the market, and it certainly has been a tough year and lived up to those expectations. Now, this fund, it's weathered the storm, and it's done very well. We got a lot right defensively positioning the fund, and we're in a position to go on the offense if and when the opportunities present themselves in the marketplace. And we'll get into that in a little bit. Let's jump into the presentation now. So as usual, I'm going to start with state of the market, and there's only a few slides I'm going to go over here. We could have an entire webinar on state of the market, but interest rates are the biggest issue we are facing today. And what you see in front of you, the light blue line shows the borrowing costs of a 30-year mortgage. And this information, it doesn't even capture the last kind of 30, 60-day move. This is through the second quarter. The blue bars below show the year-over-year change in the borrowing rate. And you can see we've had 9 consecutive quarters of increasing rates. And to put this rate move in perspective, in the entire history of the United States, long-duration treasuries have never lost money for investors 3 years in a row. And that streak looks like it's more than likely to end this year. So it's unprecedented what we've seen. And I think it's the magnitude from where we came from and what people were maybe used to. I know this isn't out of the context of long-term historical rates, but I think we have to keep in mind where we have been and what people have gotten used to in the last 2 to 3 years and some of the impact of that as well. It's translated, I think, in real estate into one of the worst capital markets environments we've seen in 15 years. But there's light at the end of the tunnel. The Fed seems like they are close to being done, and inflation is coming down. The economy is strong. And we're invested in an asset class that has really good long-term fundamentals. We have some short-term supply to get through, and we will. And there are always what I call 2 sides to the coin. So these interest rates, while they hurt us from a capital markets perspective and evaluation and have increased cap rates, they're actually helping from an operational perspective. And let's jump into slide 2. So we've shown this chart on many of occasions, and it illustrates the delta, the difference between renting and owning, and it's by far our biggest tailwind and what's keeping the operational performance of this asset class strong. And this is also another record being broken by this market. It's the largest gap anyone has ever seen between renting and owning. It's the largest gap in the history of the United States. And like the last chart, this gap doesn't take into account the last 90 to 100 basis point move. So this is actually much worse for renters versus owners than what is illustrated here, or I should say it's even better for renting. And renters are going to save close to $1,000 per month versus owning a home. There's always other reasons to own a home, and there's certainly a lot of emotional reasons why you want to own a home, but at some dollar amount, that inflection point moves the other way. And we've certainly seen there historically. You can kind of see this chart. The difference between renting and owning is a couple $100 a month. Now it's close to $1,000 per month. Significant. And the other thing that is really, I think, benefiting as a result of this is that the for sale market, there is no inventory. I was reading today, I was looking at Zillow, 80% of homeowners have a mortgage less than 5%. 62% of homeowners have a mortgage less than 4%. And the debt has actually become a huge asset that people don't want to give up. And it's the main reason why we aren't seeing prices come down in the face of 8% mortgages today. There's just virtually no inventory in that side, keeping people or keeping renters sticky. So the demand for apartments is helping absorb the record supply also coming into the market over the next 16 months. And I'll talk about that in this next slide. So I've made this kind of easy for you. It's a little noisy by putting these orange boxes around the markets we're focused on, but this chart shows the historical absorption rate of renters versus forecasted absorption rate in each market. So we do have a lot of supply coming, and if the supply were hitting these markets in sort of your historical, it would take years for it to absorb, but there's nothing normal about this market. And you can see what the forecasted absorption rates are in these markets and how much higher they are above your historical average absorption rates as well. There is record supply in the Sun Belt markets, and all of this will eventually get absorbed. And the question is always at what price. I remember, looking back at the 2008 crisis and forecasters saying there was 12, 13 years of inventory down in Miami in those markets, and it all got gobbled up in a year. So, there's always the dynamic between supply, demand, pricing. And so you have to take all these into account. It's never as bad as people say it's going to be. We've already seen, though, rent growth come down slightly in these markets, making it a little more attractive for new renters. And that will likely continue through the first half of 2024. Now, every forecast we look at, including our own Multilytics, is looking at rent growth higher in the latter half of 2024. And that demand, it's largely driven by this gap of affordability between renting and owning. And that might sound counterintuitive that we're going to have rent growth in the face of all this supply. But I would say that, it's just as perplexing as looking at the housing market having increasing prices in the face of 8% mortgages. That doesn't make sense either. So there's demand is always amorphous. It's very difficult to measure. Supply is easy. It's quantifiable. And it's difficult as humans to look at this stuff. And this is why we employ Multilytics, which analyzes billions and billions of pieces of data monthly. So we rely on machine learning rather than our own gut, but we certainly pair these together. The next 6 to 18 months are really going to be defined by this absorption of supply. And the good news, I think, is that transactions this year are down around 60%. So the inventory being delivered in the back half of 2025 is far below historical averages. And you've probably heard the phrase, stay alive until 2025. It'll all be fixed in 2026. And that's true. And we're going to get through all of this inventory in 2024, 2025, and the future in this asset class looks really good. Let's move to the next slide. So this slide is I'm going to jump into the portfolio now and then go over the valuations. We can talk more about maybe the macro environment in the Q&A. But what you see in front of you is the breakdown of the portfolio. 58% of the fund's equity is invested in preferred equity, 19% is in core stabilized property, 17% is in ground up development, and 6% is in cash, really waiting to be deployed for investments that have already been earmarked. In the NAV, the net asset value of the fund, the amount of equity plus depreciation stands at around $426 million. And the unit price is $11.16. And that unit price was just reduced from $11.30 to reflect the higher cap rate environment. And I'll go into that in more detail in a minute. But it's important, the unit price, because anyone who buys in today will acquire units at this new price. And certainly if you're in the drip and your distribution yield is being reinvested, it's being reinvested at this lower price as well. And you can see leverage in the fund is conservative here at around, a little over 50%, and the distribution yield is 5.9% per month. We got a lot right in the last couple of years, which is why this fund is generating positive returns in one of the most difficult markets we've seen. We've been defensive for 3.5 years now. We haven't bought a single asset since March of 2020. And at some point, it will be time to go on offense. And we think that's going to happen in the next 6 to 12 months. And I think that's the great thing about this fund is it is dynamic, and we're going to see a lot of interesting opportunities in the next year. And this fund has the latitude to take advantage of whatever lies ahead, whether that's in credit, whether that's in distressed opportunities in common equity. If it's market normalizes and there's more great ground up opportunities out there, then those are the areas that we will invest. But we will always invest opportunistically and find the best risk-adjusted returns for this particular fund. Next slide. So now I'm going to go deep into the valuation and cover each part of the portfolio. So this is important because how a fund's assets are valued, it dictates the price you are acquiring units at. And the fund's unit price is made up of the value of the underlying assets. And if they are priced too high, you wouldn't want to buy in. And if they are priced too low, you would want to acquire more, but that's at the detriment of current investors who are already in the fund. So our goal is to price assets fairly so that people getting in and out of the fund are acquiring assets at today's value, not at a discount, not at a premium. And that's, something that we control on our end. What you see in front of you are the values of our ground up development assets, and everything on the left in the gray header is the original underwriting. And on the right in black header is our revised forecast underwriting based on current market information and where we believe we are today with, and the biggest movers are going to be your rents and your cap rates. Last month, we've moved these cap rates from 4.85% to 5%, and that's on a stabilized basis. So these assets are generally expected to be delivered in the next year, year and a half, 2 years. And I'll tell you just anecdotally, and not even like brand new, well-positioned properties, they've been closing at 4.5% cap rates in the last few months. That doesn't reflect this latest move in the underlying interest rates, which we are absolutely trying to get ahead of. And some of our change in the prices here is really anticipation of this latest move. I think in every case, what you'll notice here is our rents have blown away expectations, which has significantly offset the rise in cap rates from 4.1% to 5%. And keep in mind that many of these deals were invested in when cap rates were below 3.5%. So our stabilized 4.1% cap rate was fairly conservative at that time, as were rents. And it's that underwriting that has really helped us, even as we've seen this massive move in cap rates. And ground up development was, and even is today, still a defensive play. The development margin is what protects our downside. When you have a development margin of 35, 40% and the market erodes, that's the first place that it's going to hit. If we bought stabilized assets at that same time, they would be down 30, 40, maybe even 50% as we sit here today. Now, Our profit has eroded, but we aren't losing money, and the fund will continue, because keep in mind, the values that you see on the right, what we're showing as the potential profit at these 5% cap rates, that's in the future. And the fund, as we continue to accrete towards these values, they're not valued there today, but they will in the future. So that slope has declined, but it's all accretive to the fund's unit price. So if you're buying into the fund today, if you're an existing investor, this is what you can expect from a gain perspective in about a year and a half or 2 years. But this is not what the fund has been written up to today. It's that stabilized value that we're constantly looking at and changing. And we have an entire valuation policy that speaks to how we're valuing assets in that sort of development phase. Let's jump over to the next one, which is our preferred equity valuation. And these values are, I think what you'll notice is we've color coded this. So you see red and orange and green here to make it very easy for your eye visually to focus in on the areas you want to focus in on. And these are accrued values as of stabilization. This isn't our LTV as of today. It's still a year and a half or 2 years out. The left-hand column is the base case, and it values the assets on a stabilized basis at around a 5% cap rate. To the right of that, the next column, you'll see what happens if we value these assets at a 5.25% cap rate. And anything in red shows that we're above a 90% LTV. Green is below 90%. And today, as we sit here, right, not minding this chart in the red, all of our investments are below 90% loan to value. It's the accrued interest over time that takes us above these levels. And so in this portfolio, we have deals that will end up being stabilized at 57% loan to value, and deals that will reach 99% LTV, assuming that the cap rates stay here. I think I may have mentioned this, but we're not, maybe I didn't, we don't accrue interest as we go above 90% loan to value. It doesn't mean we won't collect it. This is really for valuation purposes only. We have to have a way of actually writing down the preferred equity, or at least not accruing, because it doesn't make sense if something is at 90, 95%. At some point, we have to actually take an impairment of the loan itself. This portfolio produces a little more than a 1% return to the fund each and every month. And it really provides the protection and the consistent return we all want and we look for in this particular portfolio. So it's definitely served its purpose and more in the last 3.5 years. Next slide. So this is the last slide I'll cover before I hand it over to Marc. This part of the portfolio makes up about 19% of the fund's equity, and I'm going to focus on that top one, Madison at Westinghouse, because if you look at the right there, the 3.9% cap rate really jumps out. Now, the real asset we have here is the debt. We have a 35-year HUD loan on this asset that is locked in at a 2.5% interest rate, and it's assumable. Now, if we value this asset without the debt, it would easily be a 5 cap. It would be the same as the other assets. But because they are coupled together, the debt actually adds around $17 million to this investment, if not more. If we were to sell this to a buyer at a 3.9% cap rate, they would actually be achieving positive leverage in today's environment, which is nearly impossible. If you were to go out and buy a 5% cap rate today, or an asset valued at 5%, you would be borrowing above 6%. You would actually be paying the bank every month. So this particular asset, we've seen these go up for sale in the market. Buyers are lining up and bidding these properties up significantly because they're interested in pairing a long-term asset with long-term debt. And this is just an absolutely phenomenal asset for this fund. And that's why, you know, you look at the cap rate by itself and it jumps out at you. But when you add the debt into the equation, it begins to make a lot more sense. Our other assets here are valued at a 5% cap rate, and that valuation really hasn't changed since the last update, and it's consistent with our view of the world that high quality assets right now, newer assets in major markets, secondary markets, are trading right around this 5% rate. So that's the end of my part of the presentation. Marc, I'm going to hand it over to you. I'm going to go off video here, and then I will see you at the Q&A.
Thank you, Michael. So Michael just touched on a couple slides ago, the preferred equity portfolio. I'm going to touch on some of the recent preferred equity executions that have been completed for the fund. And we'll further illustrate how these investments are in a very well-protected position. It's not by accident that the majority of the activity, the recent investment activity in the fund, has been preferred equity. And that's essentially for two reasons. It's the highest margin that we're seeing in the most protected position. The combination of those two provide for opportunity for the fund to continue to grow, but also mitigate risk in a currently challenging environment. The first deal is Marlowe. Marlowe is a 324 unit, 3-story garden project located in really high demographic and rapidly growing, expanding West Henderson submarket of Las Vegas. Site is about 6 miles from the McCarran Airport and 10 miles south of the Vegas Strip. This is a convenient location. Will provide our residents with excellent access to hundreds of thousands of jobs and obviously endless entertainment in Vegas. The site's also located less than 4 miles from what is now the headquarters and practice facilities for the Raiders. And around all that, there's a master plan mixed-use entertainment district that's going to surround those facilities, which will be a great amenity for the project. This is a project that's under construction. Our preferred equity position, as you see in the slide, sits between 51 to 64% loan to value. That is based on the 5 and 5.25 cap rate sensitivity that was illustrated on the slide that Michael touched on previously. Our hold period here is probably about 3 to 4 years. That allows time for the construction to be completed, project to lease up, achieve stabilization, which will allow it to be refinanced optimally, and the preferred equity position will likely be retired at that point in time. We're earning a 13% rate on this investment that compounds to a 13.8% IRR you see here, and over that 3 to 4 year period, you're going to get a 141 multiple. The fund equity that will ultimately invest, we're investing it sort of over month as each month as construction progresses, is a little under $12 million. Next slide, please. Madeira Gilbert, now also a preferred equity origination into a new construction project. Madeira Gilbert will be a 276 unit, also garden. That's also kind of an important theme to note. When you have a market environment where rents are slowing, the cost of construction is rising, we're staying away from the higher cost, more expensive construction that requires higher rents and limits your demand segment. So it's important that what we're building is high quality projects, but projects that can attract the largest segment of demand in the market. We're not just trying to get the top 5% of incomes to be renters in our project. We can cast a much wider net. And I'll talk about how that affordability really matters on the next few deals, which are geared towards affordability in particular. But Madeira Gilbert's located directly across from a master plan community. It's over 160 acres that includes parks, restaurants, and retail. It's called Agritopia. It also our project has easy access to Loop 202, which will provide our residents with ability to commute to over 274,000 jobs with a pretty easy commute. In Phoenix, if you've been out there recently, you've noticed that that over the last few years, traffic has become a bigger issue. So proximity and easy access to commuting to different locations in the market's critical, and this asset certainly provides that. This project's going to, although it's a garden project, we focused a lot of time and attention on providing what we believe will be the best in market community amenities. It's also going to have 2 ground level retail spaces, about 19,000 square feet. Just touching on Gilbert for a moment, it's one of the highest demographic submarkets in all of Phoenix and in the country. 118,000 K is the median income. That creates one of the strongest affordability ratios when you look at incomes versus the rent that we need to achieve our returns. It's one of the lowest in all of Phoenix at 24%. You also have a low median age here, 33.9, and a very high college education level, above 70%. That's likely to attract future job industry growth into this submarket, another positive. And so we really believe strongly this asset in this location is squarely in the path of growth. Just touching on the retail for a second, obviously we look at retail as being a higher risk investment than multifamily. But the city of Gilbert originally mandated a mixed use concept for the site, where they were going to require 40 to 50,000 square feet of retail as part of that plan. We were able to negotiate down that to 19,000 square feet. Further, the underwriting for this project is underwritten at rents that are 20 to 35% below the retail that is across the street in another project called the Tyler, and the retail that's in Agritopia that I mentioned. There's the demand is proven in those other projects. They've been 100% leased and leased up quickly, and pretty high-end retail that will serve as an additional amenity to the project. Again, this sits in a very well-protected position between 51% and 67% LTV. There's a significant cushion of common equity that protects us from disruptions in rents, expansion in cap rates, or increases in uncertain increases in cost as the project continues along. Next slide, please. McKinney Falls is a project, a 290 square foot, also 290 unit, surface park. It'll be 4-story elevator, new construction project in Austin. This is again a preferred equity origination. It's located nearby to the Austin airport and close to the Austin CBD. You can get to the Austin business district without getting on I-35, which also anybody who's been to Austin recently knows that can get extremely congested. So that's a huge plus. It's going to be immediately adjacent, and we'll have direct access to McKinney State Park, which is 640 acres of popular recreation, hiking area with some bike trails. And our property, basically, you can leave the property and immediately enter into the park. So, and you'll have views from a lot of the units into the park. So it's a very nice setting. But the really interesting thing about this deal, and it'll be a theme I'm going to talk about in the next couple of deals, is that we've negotiated a structure whereby the entirety of the real estate taxes are eliminated for the next 99 years. And in Texas, taxes are a significant component of the operating expenses for a multifamily project. They also get reassessed on an annual basis. So there's a lot of uncertainty about, okay, what will those taxes be in a year, 2 years, 5 years, 10 years? We've eliminated the entirety of that risk. In exchange for that program, we've had to agree to certain levels of affordability. Roughly 50% of the units have to be rented at rents at certain percentages of AMI. What's interesting about AMI is, given the significant inflation that we've seen over the last year, that AMI has grown faster than market rents. In Austin, we saw 4% increases in AMI. That wasn't underwritten when we decided to make the investment in this project. So that is upside. That may not always be the case where the affordable rents grow faster than market rents. It certainly hadn't been the case over the last few years, but it's happened now, and certainly provides us with other risk mitigation. Affordability is a big issue now, given the significant increase in what it costs to build a project and deliver housing. Michael talked about the demand side, and we've seen some wage growth, but the cost of renting an apartment has increased substantially over the last couple of years, outpacing wage growth. So our ability to provide some level of affordability just broadens the demand segment and allows us to mitigate risk. Right now, as you see from these photos, construction has started. 5 of the 7 residential buildings have started framing. The elevator towers, you'll see those in the pictures, are complete. Right now, we have 1.3 million of buyout savings on the construction budget. We can use some of that for additional upgrades to enhance rents over underwriting. And just talking about the savings, we really haven't seen a decrease in construction pricing. We're seeing that kind of settled out. What we are seeing a tilt relative, let's say 6 months ago, a year ago, is that we're able to sign construction contracts with minimal allowances, where the majority of the contract is guaranteed by the contractor. They're not looking for language or fighting over language that allows them to basically avoid guaranteeing certain things because of any sort of act out of their control. And that's really important from a risk mitigation. So this deal provides you margin through the avoidance of real estate taxes. The amount of rents that we're having to decrease to meet the affordability requirements is well below the benefit of removing the tax expense. And we're also seeing construction progress. That's minimizing risk. And we're also seeing less risk in terms of construction execution or negotiation of GMP contracts. All that is showing up, as you'll see in this deal. Our position is 49 to 60%. That's below the last 2 deals we presented, although those were very attractive positions in the capital stack. Because of the affordable structure, we're able to take advantage of even more risk mitigation Project McKinney Falls. Next slide, please. Bobtown, same story. This is in Garland, Texas. This is a submarket of Dallas. It's a good location with access to the major employment hubs in Dallas and north suburban Dallas in terms of employment, shopping, outdoor activities. This deal also has 100% property tax exemption in exchange for affordable rates. And as you see here, also a deal that has more margin that shows up in our position in the capital stack, also 49 to 62%. You're getting the same return, the 13%, as what the fund will generate in Marlowe or Madeira Gilbert, but you're taking less risk. And these deals are very hard to come by now. We're gaining a lot of popularity. We've done 5 or 6 of them now across different funds. IncomePlus is taking advantage of them across a number of deals, as you can see here. But the legislature has changed some aspects of the program to make it less favorable. What you're seeing here on these deals is the more favorable. And so we've been able to get in, grandfathered in, because we've got early into investing in these type of projects. Next slide, please. So Stonehawk Den will also be a fund investment, but currently the equity required for this fund will likely surpass the amount that's available for investment by IncomePlus. IncomePlus, we've got listed here a $1 to $2 million investment. That's a little bit of a moving target now. That could be larger, but will likely come out with a sidecar investment opportunity to fund investors. This is not pref equity. This will be a common equity investment, but also will benefit from PFC tax exemption, again, creating a better margin on this deal. We're targeting, because it's common equity, you're taking a little more risk than you are in the preferred equity position. You should get higher returns. And we're projecting over a 5-year deal on a net basis, 2 sidecar investors, a little under 17% IRR, and an equity multiple of 1.53, both higher returns that we see in preferred equity. But what's interesting about this is you have the significant margin protection of the avoidance of taxes, while you're also creating a larger segment of demand through affordability. So be on the lookout. We'll likely providing additional details on this opportunity in the next few months. I think we can now go to the Q&A, Michael.
Great, Mark. We've got some really good questions here. We can jump in. I have a couple that I'll just jump into that were emailed in advance, and then we'll get to the ones that were sent in during the presentation as well. These are easy, and Mark, while I'm doing this, maybe you can tee up some more for you, but are we going to see a dividend raise in 2024? That is absolutely our goal, is to raise the distribution yield each and every year. We've done that for the last few years. So you can expect that in 2024, but we'll still have to go through the math. There's always a chance we don't do that if we don't have the cash flow for it. Next question I'll take really quickly. Are you seeing competitors turning apartment projects into condos due to imbalances in the markets? The answer to that is no. We're not seeing that. If anything, we're maybe seeing some office buildings converted to apartments and some other uses. Office are obviously trading for very low value right now, but we're not seeing this, the condo conversion at this point. We could in the future, though, if the math works out on that side. Mark, you got the next question.
Yeah, this was one that was submitted in advance. Thank you for your question. The question is, how long do you think you'll prefer ground up versus value add investments? Will that change, and when? To answer that, I'm going to actually go back in time a bit to 2020, when we were emerging from some of the early uncertainty with COVID. That was the last time that we did a value add or core investment, late February, early March 2020. And that was by design, because immediately coming out of that, what we saw due to the low, basically zero interest rate environment and strong demand, there was strong new household formation, which fueled massive rent growth in late 2020, early 2021. That also fueled a massive surge in valuations and pricing for existing assets. And some of those assets were, over 5 years old, but we're trading at premiums to what it would cost to build brand new. So we pivoted away from that, because we always look at replacement cost as being a very important measure that you can't ignore, that you don't want to go above replacement cost on an asset that's 5-7 years old in a market that is delivering new product that will be outcompete that product. And so that's why we pivoted to a lot of ground up, a tremendous amount of preferred equity. That's 58% of the fund. Those are in safer positions with higher margins than buying new assets. With a sustained high interest rate environment, we can't say for certain how long this interest rate environment will last, but the general sentiment is that it could be longer, or this higher rate for longer. That's likely, as Michael noted, to create some stress, some distress. We're seeing some early signs of that, but we haven't seen sort of a full market correction. And that's likely because investors, especially syndicators who were very active in 2021 and in 2022, buying assets at very low cap rates, as Michael mentioned, sometimes below 3.5%, buying those at above replacement costs, and then leveraging them up to sometimes 70% or higher with floating rate bridge debt. Their maturities haven't happened yet, but those maturities will be coming likely in 2024. They won't be able to extend those debt, and they won't be able to refinance. And the bridge lenders who've been lent to them will not likely, I mean, there could be instances, but I think it's safe to say as a general description that they will look to take over the assets and put them back out in the market and just get out of the law, mitigating their losses. So we expect those opportunities to occur. Now, certainly we could see some relief in interest rates and that could change, but we're expecting those opportunities. We're starting to see the early signs of that, where there's opportunities to provide what we would call gap equity, bridging or refinance where you don't have enough proceeds. But the full on where the buy opportunity hasn't come yet, but we anticipate that it will, and could be just in the next, certainly 3 to 6 months or later in 2024. Michael?
Yeah, this question is from Christine, and I have to take it because she's calling me out on something I said on a previous webinar in a kind way. And so I always try to be careful about what I say, how I say it, and certainly when I say something, I believe it. But she's asking about the write-down in the NAV plus the write-down in June, and it looks like the total return for 2023 may be in the 2 to 3% range at best. And that's despite having the portfolio in preferred equity yielding 12 to 14%, the swaptions, et cetera. And then I said in a webinar, paraphrasing, she says in quotes, don't wait for the NAV to go down because it won't happen. So hopefully I said likely won't happen, or compliance is going to be all over me in that case. And Christine, all I can say is, yes, I was wrong. There were a couple of events. One was if you tuned into the previous webinars or any of the updates, not being able to secure the PFC in one of our Texas assets caused us to write down the one of those properties and take an impairment, and we decided to do that. And then the other one is just the general rate market that went farther and faster than I could have ever predicted, and anybody here at Origin. So I think yes, we've written them down. I didn't think that was going to happen. I didn't think we'd be sitting here at 5% cap rates. I think, and I said this earlier in the presentation, all things being equal, we can lose money in this fund. I was at an investor event in New York City last week, and the question always comes up, in one way or another, and I'm always, honest about that. Look, at some point, the market stresses to a level where we will lose money. But I will tell you this, that, those who are in this fund, in this capital markets environment, I hope you're happy that you're in this fund and how well protected it is as compared to the write-downs that other funds are having to take during this period. So 2 to 3% is not the bogey we're looking for in an environment like this. That can certainly change. We've took what I'll say are some dramatic write-downs this last month, but we all agreed that they were necessary given the rate of change in interest rates. I just read a Goldman Sachs report the other day that they think the 10-year is going to be between 4 and 4.25 by the end of the year. If that's the case, a lot of this turns around, and we will be marking those assets up, between now and the end of the year. So, it could be that we end up 4 to 5% total return by then. But keep in mind also, for those who aren't in the fund, our total return goes beyond just the unit price. We distribute 0.5% per month, roughly, in distribution. So when we write down the unit price by 1.25, and then you add in that 0.5%, the total return for that month is minus 0.75%. But Christine, I appreciate the question. I appreciate you keeping me honest and watching all of our webinars, and I hope that answers your question.
Yeah. Here's another question that came in advance. Thank you. Your question, are the preferred equity investments in the fund structured on a fixed rate arrangement or a floating rate arrangement? They're fixed. We have discussed on a couple of the recent opportunities that we've evaluated of structuring those on a floating rate, given the volatility in interest rates, making sure that we don't sell so short. But in terms of we're always evaluating, even on the fixed rate structure, where the rates could be when the market was at its most competitive in kind of late 21, early 22. We had issued term sheets below on preferred equity at higher levels of risk at 11%. And those deals made sense relative to still investing in common equity. You're getting higher returns at the time than investing in common equity, and in a lower risk position than common equity. But today we're not going above 80% of cost, in some cases staying below 75% of cost, and we're getting anywhere between 13 and 14% on preferred equity, and we're having conversations about testing at 14.5 or even 15. We put out a term sheet last week at 15. So we're constantly reevaluating the market and assessing that rate. We haven't yet structured a floating rate. It's not entirely commonplace in the preferred equity space, but certainly something we could consider. But we do mitigate risk by adjusting our pricing based on what we're seeing in the market. And we're testing the market. We're seeing how hard we can push. Michael?
Yeah, I would just add to that, Mark, even if we're not floating rate, when, if we look back a couple of years ago, when we were issuing at 12%, even the 10-year today that's approaching 5%, that's still 700 basis points above the 10-year, which is a healthy spread in this environment. Even today, we're getting more than that, getting about 14 to 15%. But looking back, the ones that didn't float, they're still okay and probably even more protected. This next question is interesting. This is from Anonymous, and they said, it's interesting that you're making equity investments and stabilizing your developments at around a 5% cap rates, while MAA and CPT, these are public equities, primarily, they're all invested in multifamily in generally the same regions that we invest in as well. But this person said they're now trading at 6.5 to 7% cap rates. Are you looking at buying more of the REITs versus deploying capital into new development deals? The answer to that is that we are not buying any existing deals today at 5% cap rates. The negative carry is something that we just can't stomach, and it's not a prudent move. The market decides what the cap rates are today, and we can decide whether or not we want to play in the market. So we're not. There is one development deal we're looking at it. It's not your general run of the mill. It's a public facilities corporation deal down in Texas. We might be coming. This fund will have a little bit of exposure to that, but it's a very unique opportunity that we've done before. But in terms of your question, MAA and CPT, I certainly keep an eye on the public REITs every day. I look at those. They're a good proxy for direction, but they're not always a great proxy for cap rates and where they should be. And you have to keep in mind that in a public REIT, you have anywhere between, especially the scaled public REITs like these that are large, 1% to 2% of whatever the cash flow is going to go to G&A. So those public REITs tend to trade at much higher cap rates than the private market to account for that G&A. And they can also become very decoupled from the private market in extreme times like this, which means that for an investor, it could be a great buying opportunity. And if MAA and CPT are trading at 9 caps while the prevailing market, the private market, is trading at 5 caps, those would be a better buy. I think right now they're probably fairly priced. If the market recovers, you'll certainly see those stocks recover first, just like they started going down first. So I think they give you great general direction, but maybe not perfect insight into cap rates. And if I go back to 2008, I remember I was studying back at that time. I was getting my master's in real estate and taking a public REIT course, and we're pulling these things apart while the market's falling apart. And I found it so intriguing, just to your question, that the market, certain really high quality REITs were trading at 9, 10, 11, 12% cap rates, while you couldn't even buy a 7% cap rate on the private side because the liquidity of the market, sometimes people are selling and not thinking about the underlying valuation of the assets, but that would have been an absolutely great time. So that's a long way of answering your question. No, we're not buying public REITs today, and we're not buying any private investments either at 5% cap rates. And the only place we're allocating money today is in very unique ground up developments that have significant edge tax credits or into preferred equity.
Yep. Michael, this is a question that came in from Ashwin. Thank you for your question. What is the multifamily supply you see in 2023, 2024, and 2025 in terms of number of units? So the latest statistics that we've seen and that we're tracking is that there's 1.1, just over 1.1 million units currently under construction. Most of those are still expected to deliver and get completed this year or the first few months, first half of 2024. There's about 400,000 of those that are currently in lease up. This is nationally. And that's in line with a little bit above the 12-month average of 421,000. What's interesting is that because of high interest rates and a lot of regional banks, which are the lender, provide the majority of financing for real estate multifamily construction. It's not the JP Morgans or the Bank of Americas of the world. It's regional construction banks. Well, the regional construction banks, because of some of the banking stresses we've seen earlier this year, are feeling pressure from regulators to be a lot more conservative in terms of their reserves. And so a lot of what they're doing is only for, long-standing clients. If loans are being repaid to them, they're recycling those proceeds to those existing clients. They're not originating a lot of new construction loans, or if they are originating them, they're at much lower loan to cost ratios, which are making a lot of developments not pencil. So we're going to see, and we believe, a pretty significant slowdown in new construction starts in the next 12 months. And what that means is, in 2025, 2026, you're going to see a shortage of supply just based on the demand for housing in this country. Now, of course, mortgage rates could come down. That can allow people who want to own a home, who are forced to rent today because of what the cost gap that Michael illustrated earlier. But there are a tremendous amount of people who are still choosing to rent by choice. There are a number of people who still won't be able to afford the down payment for a home because of student loan repayments that are coming back, or their inability to have savings in the down payment or afford the additional cost when you don't have the 20% down payment. So there are a lot of statistics out there that are showing the overall demand for housing, even if home sales kick back up and new home starts kick back up, or they've kicked up a little bit this year, but kick into overdrive because mortgage rates come down, that there'll still be a significant amount of demand for multifamily. And we're likely to have a housing shortage just because there's not new construction starts that will probably occur that many in 2024. Michael?
Next question is from Kai. This was emailed in Q&A, or not emailed, sorry, put in the Q&A. I see a CoStar article that StoryBuilt, the company, is selling their stakes in multifamily developments. Is this something IncomePlus is looking to invest in to take advantage of the market? Maybe not this specific deal, but something similar. Kai, we're looking at everything when it comes to being opportunistic. We've seen some interesting deals out there, nothing that we would bid on, but starting to see signs of distress, and it's distress in two places. Yes, in individual assets, but maybe not a buying opportunity. I heard of a deal recently where a developer, they put all their equity into a deal. Now they can't get a senior lender and they're kind of stuck. 20% built and all the equity is in, and now they're looking preferred equity, but there's no opportunity in that particular situation unless they go into bankruptcy court, and we could buy that significantly cheaper because we'd have to finish it and take on a lot of risk. Also at the corporate level, some of these less, these smaller groups who aren't capitalized that well, or maybe got over their skis and they don't have the liquidity, they're actually reaching out and looking for liquidity because they might have decent balance sheets, but you need cash to pay bills, and balance sheets don't cut it. So we've seen that, and there's inklings of distress certainly on the lower levels when we're talking about workforce housing and some of those assets that we don't really play in today. And so like we're constantly evaluating the market and looking for the best risk adjusted opportunities. We're not looking at anything with story built, but there's a lot of talk about distress out there. I think it's idiosyncratic. It's not in the whole market right now. But you can rest assured this fund, if we can find them, we absolutely will. And we'll make those investments either through this fund or in a sidecar.
Thanks, Michael. There's a question from John. What part of your portfolio going forward will distressed asset acquisitions represent? Perhaps a range. It's difficult to say at this point because we've yet to see the pricing fall to levels that make this attractive. We're expecting that to happen. Well, it could be, a fairly significant opportunity. It's also going to be likely a fairly competitive market environment, but we've got a proven track record of being able to find deals outside of broadly marketed process, off-market opportunities. And because we provide such a broad range of solutions to buyers and other capital partners through, hey, we have credit and preferred equity, we can provide common equity, we're going to see a lot of deal activity. So I think it could be a pretty significant part of the fund. There's also a question from Anonymous about with 6%, with cash only about 6% of the fund, do we have enough dry powder to take advantage of dislocations? And yeah, we'll be looking to utilize that cash for that. We also anticipate at some point over the next 6 to 12 months, some of the preferred equity investments to return that capital can be reinvested into these opportunities. So there'll certainly be availability, we believe availability of capital, and an opportunity to take advantage of those dislocations in the market.
Skip asked the question, when interest rates fall, assuming there is significant pent-up demand for home ownership resulting in a drop in demand for rental units, how is the fund positioned for this potential market dynamic? Skip, I actually share your concern for around this very area, and I've voiced it internally. But I think there's a couple things to consider. Like this demand has certainly helped us, but if interest rates come down, the multiplier, the cap rate should follow to help us on that side. The other thing that as a company, what we're talking more and more about is how do you meet investor demand and meet them where they are? And certainly traditional multifamily is not a perfect substitute for home ownership. And so what we're focusing more and more these days is build for rent. And build for rent is like single family rental, similar, but it's actually a community that's purpose built around townhomes, single family rentals, things of that nature. It has centralized leasing, amenities, and it's very much a substitute for home ownership. And that's some of the things that we're really looking for internally. So future ground up developments, we certainly favor the build for rent more than the traditional multifamily. It's something that we're mindful of, this very issue, and making sure that we are meeting the market, because as this demographic, these millennials move through, there isn't as much demand. It doesn't fall off a cliff by any means, but there isn't as much demand or growing demand behind this millennials. And they're now at a peak age of about 33 and dying to buy homes. And it's why we've seen strength in the home market, even in the face of 8% interest rates.
There's a question from an Anonymous. What is your expectation of the IncomePlus Fund unit price throughout 2024? So the preferred equity investments, as Michael mentioned, grow at about 1% per month. We just adjusted the curve of appreciation on developments, as Michael described earlier in the presentation. But going forward, if we feel comfortable that another cap rate assumption adjustment isn't necessary, those investments will grow between more like 1.5% each month. The common assets will generate, cash flow yield. I don't anticipate a significant amount of appreciation in those assets. Although in Houston district, we brought that asset down, there could be an opportunity to bring that up if we are successful in structuring the PFC similar to the deals that I was talking about earlier, like McKinney Falls and Bobtown. So, but outside of that, and there's certainly some uncertainty around that we can't bank on just yet. Those assets aren't likely to have significant appreciation. It's just based on what we're seeing in the market, that cap rates could come down and that could fuel appreciation, but we're not anticipating that in the near term. So when you factor that all in, the fund could grow in that range of about 5% in terms of appreciation when you blend all that together. But there's certainly and we can provide updates as we move along and see where pricing goes in the marketplace. But that would be our best estimate right now.
Mark, I'm going to grab a few questions just in the interest of time. These are all from Anonymous. Any update on the common equity development in Austin, Texas, Blue Ridge? Yes, we're going to be sending something out in the next month, so be on the lookout for that. I kind of mentioned it a little bit. This is going to be a ground-up development. That's a tax credit deal, and where typical ground-up developments don't pencil out in this market, but this one actually does because of the tax credit element. The other question, let me get rid of that one. Just so
that actually was Blue Ridge they were asking about, Michael, and that deal is less certain now. It's been replaced by the Denton PFC deal. Very similar.
Oh, that's right. Okay, yeah.
Similar dynamics, but
right.
Similar deal profile.
Yeah. In any case, there will be a sidecar coming out in about a month. It's just not the Blue Ridge deal. The Anonymous also asked, why should we invest at mid 5% yields in the fund when U.S. government bonds are similar yields with liquidity? Seems like the risk reward is not there yet. It's a great question. This certainly is an income fund, but there's also another component to it, appreciation. And I think you can find countless number of stocks out there that whose dividends aren't trading above government yields, and people are still buying those today. And so, like in a fund like this, we're looking to achieve around a 9 to 11%. That's incredibly tax efficient. So your bonds are going to be taxed at ordinary income. Last year, we were able to make distributions and shield 92% of those distributions from taxes because of the depreciation. So you'll have to look at them both on a pre-tax and post-tax and look at the potential for appreciation in this fund. And our bogey is sort of 9 to 11% with, kind of a plus or minus 5% range around that. And this year, we are going to hit the lower end of that range. I think by the end of this year, we'll probably be around 5 or 6 or maybe even 7% total return. And the last question, can't find it. Okay, Mark, why don't you take one? I'll look for the next one I was going to answer.
This is a question from Anonymous. What happens when the LTV goes over 100 on a pref equity investment? At what point does it become a possibility that Origin takes ownership of the property? So just referring back to the slide we showed earlier, that is projecting out what the preferred return will accrue to at stabilization when the asset's likely to get refinanced and the preferred equity investment retired. If it is at 100 or above, our principal is not at risk on that schedule. We would just not get the full, let's say 13, 14% return. The return could be mitigated, but the principal, those columns were also shown, there's much more margin there before principal is at risk. We do have control rights in those projects. We're not a lender, we are an equity investor. And if that project became severely challenged, we can step in, operate the asset, take over day-to-day management. But we don't want to do that. And that's not necessarily something that, although we have rights and we can execute them, that happens at, a flip of a switch. And so we're heavily focused on that margin when we approve these deals and as we go along monitoring those deals. And that's why, we focused the conversation there earlier. Go ahead, Michael.
Yeah, let's take a few more, Mark. It's already 7 after. We'll try to knock these out. I'll take 2, you take 2. This is, can you talk from Anonymous, can you talk about the fund flows a bit is IncomePlus seeing net inflows, outflows. Inflows exceed outflows in this fund, and I think we did something very smart, is trying to match the what am I trying to say? Trying to match the policy with redemptions with kind of the long-term outlook of investors. And so we have a 1-year lockout and then a declining penalty that lasts for another 4 years. And that is something that has helped the outflows in this fund, because we really want our partners to be thinking about investing for 4, 5, 6 years, not 1 to 2 years, and taking advantage and looking at this as an alternative to a money market. And I know some other fund managers, they have much more lax rules around the redemptions, and that's actually hurt them. And those queues are absolutely full. But our inflows exceed our outflows, and I would say our outflows are de minimis right now. The next question by Anonymous. I don't know if this is a different Anonymous, but there's Anonymous that's very busy. So thank you for all your questions. Are you concerned that pref equity is becoming crowded and that returns will diminish by 2025? No, not concerned at all. I mean, we're one of, I think 2 or 3 groups that are prolific in this area. We have an incredible acquisition team. We've been in the market for 15 years. We have deep roots, relationships. It's not just about money out there. We're a value add investor, and we have repeat clients out there. So I'm not ever concerned about finding deals if there are deals out there because of the way we're set up. It's just if the risk return is there or not. And right now, I think this is the best market we've ever seen to lend money. Go ahead, Mark.
Here's a question. Shouldn't the fund start buying assets if Origin believes market conditions will normalize, financing costs decrease, and cap rates normalize? Then shouldn't the fund be acquiring assets instead of making preferred investments? Isn't the reinvestment risk of those preferred investments extremely high? We'll stay disciplined in terms of buying new assets. And so we'll buy those operating assets when the returns justify the risk, the discount to replacement cost is right. And as I mentioned earlier, we haven't really seen that yet. We anticipate it happening, and it could start happening fairly quickly at discounts to where assets were valued some time ago. But until we have to stay disciplined around the metrics that have created success. And although we've had some write-downs in the fund, if we hadn't taken that same approach with the existing portfolio in 21, 22, and the way we valued the fund, we'd be seeing a lot more volatility in this fund. So we know we need to stay true to that. There's certainly preferred equity investments that may mature in a year or two or now. There'll be other opportunities to take advantage of, and that's also the benefit of this fund being multi-strat. You can play at different types of opportunities at different points in the cycle, and you're not just stuck with one strategy.
Mark, I like that answer a lot, and I'll maybe just add or sum it up. You have to listen to the data and not have an opinion about which way the market is going. And there's certain just metrics that we look at that when you look at history, it becomes the best time to invest after a cycle. And one of those is very easy. It's having positive leverage in the market. But going out and borrowing at 6% and buying a cap rate at 5% makes no sense in today's market. And that's where we are. We're sort of completely upside down. This is why Madison and Westinghouse has maintained its value even in these rising cap rates, because of the debt we have on that side. So if and when, and by the way, I'm giving you 2 data points, but there's other ones as well that we look at, the replacement cost and NOI growth and everything else that goes into this. But we will pounce if and when the stars align, but it's not going to be based on we think and therefore this and that. It's going to be based on real information that we process, so we have a great chance of success. And until then, it feels like it could be a falling knife until that point. Market can recover, but it can also become more distressed, and we'll be waiting for when it happens. Marc, I'm going to take this last question, and then you want to sign us off?
Let's do it.
All right. Anthony, thanks for your question. Do you think you will be doing 1031 exchanges in this fund in the future? Anthony, I'm going to answer that in 2 ways. If the question is, are we going to be taking 1031 exchange capital in this fund? The answer is no. If the question is, will the fund trade out of an asset into another asset and utilize a 1031 exchange? Absolutely, because this fund is designed to be tax efficient. And I guess one more thing, everyone should know this, that one of the business lines that we are launching, it'll be launched by the end of this year, is a 1031 exchange business line, because we just see a huge opportunity in the market to we get inbound inquiries all the time. I think the market is, I don't want to disparage current 1031 exchange buyers, but it's very fee heavy. And we think we can deliver a way better product to investors in this environment. And that's why we're coming out with this, because we have 3,700 individual investors. We have RAAs, we get inbound calls all the time. And we think this is going to be a great product, and it's a need in the market for others. So look for that over the next few months.
Really good questions. Thank you, everybody.
Yeah, great questions. And thank you. If you're still here, you stuck around for an hour and 14 minutes. It's almost time for me to have lunch.
All right, thank you, Michael.
Thanks, Mark. And thank you, everybody. If you have any more questions, you can follow up with me directly, Michael at origininvestments.com. You can contact our investor relations department as well. If you're an existing investor, you have a dedicated contact there. You can always go out to our website. But we really appreciate you listening in, taking the time today to listen to this update. And we also appreciate your partnership. So thank you very much, and we'll see you next time.